Oaktree Investment Risk Officer Wayne Dahl recently sat down with portfolio managers Madelaine Jones and David Rosenberg to discuss where they're finding relative value today.
Thank you, David and Madelaine, for joining me today.
Happy to be here.
Yeah, good to see you.
2022 has certainly been a challenging year for fixed income investors, but of course with challenges usually come opportunities. You both work in high yield bonds and leveraged loans or senior loans. How do you think about relative value in those markets today when you look at both?
You can't talk about fixed income without talking about duration. And so the offset is that high yield is fixed and loans is floating. And so you have that balance right now where most of the world is concerned about rising rates. You're seeing inflation, clearly being a real issue to deal with. And so as you think about the yield, when you buy fixed income, it's, for us, you underwrite the credit. You got to make sure you don't give back the yield to credit. You also have to think about other things that can take the yield away, duration being one of them.
And Madelaine, David makes a great point about duration, and certainly something that's impacted fixed income markets this year. But how do you weigh those more macro risks like duration against, say, the fundamentals that you're focusing on?
I think fundamentals have to trump what you think about the rate environment and how that may change. Because I don't feel like any of us can second guess where rates will eventually move to or how that duration will evolve over time.
And totally agree. I think, you have to be macro aware because the macro will drive the fundamentals. Inflation will increase costs and shrink margins of credits and so forth. But, we've been doing this long enough, Madelaine and I, to know that we don't know what rates are going to do. And so you kind of have to go into it with that understanding.
And every time we look at a transaction, we're always viewing it with a hold to maturity mentality. Are we okay to invest in this transaction throughout all different kinds of markets, throughout all different kinds of economic conditions? And does the spread compensate for the relevant risk in that issuer? So I think fundamental analysis trumps everything you can achieve through second-guessing a macro call on interest rates.
And Madelaine, you mentioned being compensated for the spread, and credit spreads certainly are an indicator of default risk. How do you think about the default expectations in the market today?
Well, I think post-COVID, companies really took a lesson about preserving liquidity and ensuring their balance sheets were appropriate. So you saw companies really shoring up cash. But also, when we're thinking about balance sheets, they've extended maturities. So they've got both liquidity shored up and long maturities. That means in the near term, at least, it doesn't look like there's a maturity or liquidity triggered default risk in the next 12 months of any significance. Beyond that, it really is a judgment call on how hard you think the economic climate might change.
So I think it's a great point. If you have a maturity, and the market will not refinance you, you have to restructure your balance sheet. That's your only option. But the reality is there's been so much issuance over the past few years that less than 10% of the market is maturing over the next 2 years for both bonds and loans, which means your default rate likely is going to stay low for some time.
Is there a sector today that you see as maybe one that you're more cautious on?
It's funny, I always get cautious when everybody's not cautious. And so I look at energy today and nobody's worried about energy, so I figure now is probably a decent time to start to worry a little bit. But realistically, when we talk to companies and CEOs and CFOs about their guidance and what's driving it, the biggest concern we hear right now is energy prices. Distribution costs is a big issue. And so companies that have a high element of distribution, whether it be shipping internationally or even trucking nationally, that's become harder to pass through. That's something that we watch closely. Companies that are more service-oriented, media, telecom, healthcare, those sectors where that's less of an issue, they're a little bit more protected or healthier places to be today. So I'd say it's more thematic in that regard.
And Madelaine, is there anything in the loan market in particular, sectors that you're maybe more concerned about from a default perspective?
I think more than sectors are the smaller companies, the mid-sized companies that snuck into the loan market, really should have gone to direct lending. I worry about those in a toughening economic environment. I worry about those and their ability to pass through those inflation pressures. They just have less levers to pull. They have less diversity in their businesses. They have less access to capital and liquidity if they need it. So those are across all kinds of industries, but we know that when times are tough, smaller, medium-sized businesses suffer
What
more
about
heavily.
technology with all the LBOs?
Yeah, sponsors were very active in the technology space, and we've seen a correction in valuations there quite significantly. So that cushion underneath your senior debt has eroded quite substantially.
I used to always joke it was lazy analysis. You had all these companies come to be 10, 12 times levered, and they say, don't worry, the equity's worth 50 times, and now it's not worth 50 times. And so if you haven't underwritten the credit, you'd be pretty concerned.
Madelaine, I want to come back to something that you referenced earlier when you talked about, the focus on fundamentals. The buzzwords of the day are, inflation, recession, geopolitical risks. How do you kind of square those macro risks as you're thinking, especially about relative value?
I think you have to recognize that conditions are a lot more challenging for companies now. With inflation, how can they respond in order to protect themselves and protect their cash flows? And that comes back to analysis on cash flow forecasting, cash flow projections, and really sensitizing those cash flows for inflation and profitability destruction if they can't pass those through. So that's the fundamental risk we have to ascertain as to whether companies can do that, but also rising interest rate pressure as central banks trying to contain that inflationary pressure. There are certain sectors where the pressures on inflation are extreme, especially, I'm sure we'll come on to talk about Europe at some point, but there are some tail risks there. I think you really find there are challenging pressure points in certain industries on inflation that may be harder to pass through.
Do you think it's likely that central banks will actually be able to slow down the inflation that we're seeing today?
I've been told before that I'm a fairly ambitious person, and I do not envy the job of the Fed today. I think that threading that needle is really difficult. So if they want to deal with inflation, they really have to basically get the consumer to stop spending money. If you keep spending money on higher and higher price items, you're going to keep having inflation. And we have a consumer-driven economy. So if the goal of the Fed is to essentially weaken the consumer, that's not good for the economy. And so it's going to be an interesting dynamic because for credit, for many years now, it's been, you hear a lot of people say the Fed put, you can't fight the Fed. And the theory behind all these catchy phrases is basically that there's a desire for the Fed to continue to prop up the economy. And as they showed through COVID and other scenarios, if they really have a strong desire to do that, they're quite powerful in that regard. However, you can't fight inflation and prop up an economy at the same time. Those are a direct contradiction to each other. You have to pick one. And it seems pretty clear that inflation is what they've picked, which means that you have to be prepared for some weakness in the economy.
Yeah, I heard somebody say that the Fed used to be your friend, and maybe
Right.
now it's more likely they're going to be your fiend.
Yes.
And the one thing they can't do is correct for the supply chain
That's a good point.
issues.
Whenever we hear about supply chain, everyone says, well, COVID basically disrupted the supply chain. And I always remind people it's not just COVID. What COVID did, in my view, is took the slack out of the system. You have a factory running at 95% utilization, now it's running at 85% utilization because of the COVID protocols that are unlikely to go away anytime soon. And the reality is, historically, something would happen at one company's factory and you would never hear about it because their competitor would pick up the slack. That was an opportunity, but never really made the headlines. It was no big deal because there was always slack in the system. Now, if one factory goes out of consequence to an industry, it's headline news because there is no one to take up the slack, which means you just have less product until you can get through that. And as my team reminds me all the time when we start to figure out how's this going to play out, is that yes, economics theory will tell you that people will invest money and try and debottleneck, but at the same time, things will continue to happen. And so that means that this whole problem is not just going to be an overnight solution.
Maybe if we shift gears a little bit, Madelaine, you kind of referenced some of the risks, particular in Europe. You think about investments in both markets. Is there anything distinct in Europe versus the US that you've seen?
I think clearly Europe faces a more immediate problem on its doorstep with the invasion of Ukraine and the potential ramifications for that in terms of energy security and stability. There already are extreme price rises for manufacturers in particular using energy in their production process. There's also impacts on supply chain for automotive industry in Europe. That's finding it hard and challenging to get hold of important components for the manufacturing processes. There's also Europe and its place in the world as a fairly outward export-driven market, not only to the US, but to China. China is a very large market for Europe, and as we see some pressure on the Chinese economy, that could again cause economic pain for Europe. So the balance of risk there being more acute than we feel in the US.
Earlier in the beginning of the year, end of last year, we were favoring Europe because the view was if you were going to see rising rates, you're more likely to see it in the US first. And again, it impacts obviously the math of fixed income, but it also impacts the growth of the economy. But then Russia invaded Ukraine, and that changed the math. And so as Madelaine pointed out, now we're more concerned about the economic health of Europe, given its dependence on Russia.
There's some very substantial tail risks around energy security, which could be very threatening for Europe and European producers. And so we have to do quite a lot of deep dive analysis into how do those supply chains look, what kind of energy reliance do we have in those companies on Russian gas supplies in particular, and what would be the outcome if there is rationing of energy, rationing of gas, which they're talking about now in Europe. How will that impact companies? Which companies will it impact? And are we being appropriately compensated for that? Does it make their cash flows unable to service their debt?
It's actually much more further reaching than people think, because you think about the Russian invasion of Ukraine and people immediately go to energy, and that's clearly an issue. You also have the issue that Ukraine is a major exporter of wheat. It even goes as far as the fact that Ukraine is one of the major suppliers of semiconductor-grade neon gas to the United States, and we're already short computer chips as it is. And so, again, when you think about this issue, you really have to really go to each credit and figure out what do they need to operate their business, and are they going to actually be able to get it? And in some cases, the answer is no, and so it's an important question to ask.
I think that it makes me realize that we've lived through a period of really quite benign conditions to be a credit investor, and certainly geopolitical risk was not top of the agenda like it is today. So we have, of course, the issue with Russia-Ukraine invasion. But we also have a China which is now starting to feel a bit dislocating from the Western economic world.
But Madelaine makes a really good point. I mean, for years, we had such a benign period that when I would talk to people about investing, especially in below investment grade, I would say, well, you really have to do your credit work. And I would have people come back to me all the time, I don't have to worry about credit, I have a Fed put. And my favorite question to ask people is, okay, you're going to rely on the Fed to bail you out, that's your decision, but what happens when the Fed wants to bail you out and can't? And people would say, what do you mean? The Fed has unlimited resources, they can do that forever. And I'm like, well, forever is a long time, but honestly, when you look at it, we are finally now in a period where the Fed may want to bail you out, but they can't, because you can't bail people out of their credit decisions and fight inflation at the same time, which means that we've entered a period, biases aside, where you're going to have to actually know how to do your credit work to survive it.
Yeah, and so many risks out there, whether it's duration risk or economic conditions changing, and so many risks that the market is trying to grapple with and price, and that means a lot of opportunities for active management to find things which are being inappropriately priced, whether it's too tight or too wide. There's lots for us to do, and there's still lots, given low default environment we think will be sustained in the near term, lots of good assets that we can go to and find attractive relative value.
When you look at fixed income investing, you talk about rising rates, it's a very scary thing, and I acknowledge that. However, what I tell people is when you get through it, and you're on the other side of it, you've now actually changed the world. The yields that we're seeing in high yield are high again. I used to joke that we're going to have to rename the asset category medium yield because 4 to 5% wasn't that high, and now we're back to what we used to earn, and that changes the risk you need to take to earn the return you need to earn, and that's really powerful. And so I think that in a positive way is going to change the options investors have at their disposal now.
Thank you both so much for joining me today for this robust discussion on relative value in the credit markets.
I enjoyed it. Thank you.
Thank you.